All right, this is Gerrod Galliano and John Donnes. Welcome to Coffee Chat. Today we're going to be talking about a topic that a lot of our clients are asking about. It's a weird year, 2026. We start off with 3 negative months with a war, a lot of fear, a lot of volatility, but here we are, halfway through the year. We're at all-time highs. People are asking, should I be taking profits? Should I stick to what I have? How do you analyze something like that, John? How do you make those decisions?
Yeah, so I think the key is to really look at the foundational data of, SEC reports, just the data that we're getting within the Fed and the market, because we have had, obviously, 3 downswings due to geopolitical occurrences, but companies are still doing good, earnings are still good, so really important to get into the foundational data when there's so many different question marks in the world.
Yeah, that's a good way to look at it. So fundamental approach, as you can tell, John is one of our portfolio managers also, so he's always digging into the numbers. One thing we also like to look at, though, is the individual in terms of their own personal appetite for volatility in these moments. And then there's some things that you can't predict, like the weight of a stock. Some of these stocks, this push has been not entirely AI driven, but a pretty big portion has been AI driven. So we're looking at that also.
Obviously, hedging some of the bigger positions that might have gained a lot over your past 4 or 5, 6 years. Always good to look at rebalancing just on a yearly basis. So just because there's been so many different moves, that's always good to see, just a rebalance. Talk to your advisor about, hey, I have a lot in, Apple, Nvidia, some of those sort of things. Maybe trim some of those, allocate into different things to make sure you have the proper balance of risk that you want to have. Just making sure that all your T's are crossed, I's are dotted,
So you're talking about sector representation, making sure that, look, we see all the growth is in this kind of, we call it AI adjacent, maybe not directly AI, but what's going to produce the AI is going to be video cards, it's going to be chip processing, it's going to be some of the companies that actually cool the hardware, all this stuff in the data centers. So there's even electrical companies that are benefiting from some of this growth. So we love that growth, but we also want to make sure that there's some sectors out there that maybe didn't have their day in the sun. What are some of those sectors that we're looking at maybe underrepresented right now?
So at the beginning of the year, oil and gas was one that really hadn't had a lot of gain, hadn't had a lot of traction. But with everything going on, obviously it had a big jump. Healthcare is one of those ones that really hasn't gotten a lot of flavor recently, but that's one to kind of reallocate into for sure.
Right. Yeah, we're looking at those, and this one we keep saying watch out for it, but it hasn't happened, and that's kind of housing.
Yeah, housing.
We keep saying, look, at some point, and we talked about this before we started. It's really hard to predict what's going to happen with interest rates coming up. That's the next big hurdle. We just went through a war, and maybe not a war, but a conflict. I guess we can say a conflict, and then the market kind of shrugged it off. It lost about 6%, and then new all-time highs. So you can see the sentiment is there for a positive market, but also there's so many things hedging on this new Federal Reserve chairman.
Yeah. So
and is this guy Warsh? Is he going to be super aggressive? Is he going to attack rates? Or are they going to kind of stay the same? And what do you think about all that? What's your thoughts?
The approach is definitely going to be different. I think that we are going to look at cutting rates more aggressively, but I do think that inflation due to the conflicts is going to be a key as well. Prices are up everywhere because of gas, right? Gas prices are up. That tends to make everything else kind of follow that same trend line of everything's costing just a touch more right now because transportation costs are up to get those goods. So it'll be an interesting next few months to see what they do, and just really because midterms as well coming up. So there's a lot of question marks with who's going to be in power making whatever decisions in regards to interest rates and how the economy moves.
Yeah, that's all good points. And look, when you're trying to talk about rebalancing, changing that portfolio, remember, we are at all-time highs. If you're going to downshift, if you're going to take some gains off the table, not a bad time to look at it and say, okay, we've done really well with some of this stuff. Let's maybe, even if we stay the same with our equity representation, maybe make sure that the other sectors are getting a little bit of love. Because just like oil and gas, you couldn't predict this war was going to break out, or conflict. We couldn't predict the conflict was going to come out, but here it is. Now all these positions that have been sitting dormant for like 2 to 3 years, they're up 30, 40%, some of them. So we're looking at, same with housing, same with some of these electrical companies, same with some of these more consumer defensive companies. You can't predict when it's going to happen. So if you're thinking about rebalancing anyway and you're up 10, 15% already halfway through the year, it might be a good time to take a look.
Yeah, for sure. And then in regards to that as well, there's also some very attractive options within the bond CD space. I mean, right now, but with rates going down, bond prices will go up and when rates cut. So it's probably a good time to really look into them, because if that's the anticipation, you want to get in before the prices go up.
Yeah, still some decent long-term rates. Like 2 years ago, we were enjoying the 5.5% CDs and 6%. So, that's not here anymore. No. And eventually it's going to get worse, most likely, if the Federal Reserve Chairman keeps lowering rates. High probability all that fixed income gets more and more difficult to find, which means you're paying a premium to get that. You're not getting the same yield. So, if we can get some of that in soon, then maybe it's a good time to look at it.
So back to the purpose of like rebalancing and getting into that, I definitely think that it's good to just always check it, look into it. Is it essential? I would say no, because, just talk about it, see what you may want to do for your risk tolerance and what your main goal is in your accounts and basically in your retirement. But there are some options out there for you, and it's probably a good time to check it, see what kind of bonds or different fixed incomes would work for you and in your long-term goal.
So we talked about all these, it's not exactly a black swan event because you can predict there's going to be some conflicts at some point. But that's one of the other things that a lot of what we're talking about is logical, but that's not how the market works. The market works on sentiment, fear, excitement, all those things. So you can't predict this kind of stuff. So even though we say, look, based on historical interest rate periods, interest rate reduction periods, where I think there's like over 90% of the time when rates are going down a certain amount, the market's up. And over a 2-year period, it's almost like 100% of the time. Yeah. That doesn't mean that's going to happen, because you can't predict the kind of things that the reason they're called black swan events is you can't predict them. So even though things look like they're pointing in the direction of positivity for equities in the future, still a good idea to rebalance and maybe say, let's take some of these gains off the table.
And like you said, like within these black swan events of things happening, you can't predict them, but what you can do is kind of look at past data of what's happened, kind of like you said, and assess how the market has reacted in the past. I'm not saying that it's going to directly do the exact same thing, but you can kind of take a little bit of knowledge from that and see what we should do within the accounts 6 months, a year, 2 years after these sort of events kind of happen. So looking at past data doesn't directly reflect what's going to happen, obviously, but it's good to use when you're talking about a retirement goal or what you're trying to do with your investments.
That's good advice. Well, look, guys, thanks for joining us for another coffee chat. Donnes Gerrod Galliano, and we're talking about how to balance these portfolios in a time like this. Really wonky year so far, but thanks for joining us today.